On January 10th, 2026, President Donald Trump announced a proposal that immediately sent shockwaves from Washington to Wall Street, a federal 10% interest rate cap on all credit cards in the United States. Right now, the average credit card APR hovers around 24%, basically like paying a mini mortgage just to borrow your own money. At first glance, this sounds like a huge win for consumers. Relief, fairness, a financial reset, all the things headlines love to scream. But money doesn't respond to good intentions. It responds to incentives, not promises. And whenever the rules of borrowing change, consequences ripple quietly, often hitting ordinary people long before anyone fully understands why. Credit limits may shrink, approvals may vanish, fees may suddenly appear, rewards programs, they could disappear almost overnight. For those over 50, this is particularly critical. At this stage of life, credit isn't about splurging on gadgets or exotic vacations. It's a lifeline, a bridge for emergencies, a tool for handling unexpected medical bills, home repairs, or timing issues with taxes. Losing access can have real-world consequences. Imagine this. You've spent decades building your credit score. You've been responsible, made on-time payments, and you have a $20,000 credit line sitting there just in case. Suddenly, that line gets cut to $5,000 because a new policy changed the math for your bank. You didn't do anything wrong. The rules just shifted beneath your feet. And here's the kicker. This happens before the law is even passed. Banks don't wait for Congress to finalize legislation. Algorithms adjust, credit models recalibrate, and ordinary people feel the consequences without understanding why. Today, we're breaking down exactly what this 10% cap could mean for your money. The good, the bad, and the subtle ways it could quietly help or hurt you, without hype, politics, or confusing jargon. I'm the Asian girl, and if you've ever worried about your financial safety net, you need to hear this. Timing is everything. Banks don't wait for laws to pass before reacting. The moment their profitability is threatened, their behavior changes. Lending standards tighten, credit limits shrink, accounts close quietly, all before the public even realizes it. Headlines scream lower interest, but the reality may include fewer approvals, smaller lines, and sudden restrictions. For Americans over 50, this timing is especially critical. At this stage of life, income is often fixed, Social Security checks arrive reliably, pensions are predictable, and annuities pay on schedule. Expenses? Not so predictable. Healthcare bills, home repairs, family emergencies, they arrive whether or not you're ready. Credit acts as a bridge, smoothing gaps between when bills arrive and cash is available. Maybe your roof needs replacing in June, but your insurance reimbursement won't arrive until August. Maybe a medical procedure is due now, but your HSA hasn't been fully funded. Credit provides flexibility, breathing room, and control over your own timeline. Lower rates sound great unless the credit itself disappears, and that's exactly the trade-off most media coverage doesn't explain. Credit is rented, not guaranteed. When the price you can charge drops, lenders respond by being selective about access. Even responsible payers, the transactors who pay in full each month, can feel it. Rewards programs rely on interest income. If revenue shrinks, banks shift costs elsewhere. Fees increase, perks disappear, annual charges rise. Example, you're 62, using the same credit card for 15 years. Perfect payment history, minimal balance. Under the new cap, the bank deems the card unprofitable and closes it. Your credit utilization ratio spikes, your score drops, and other lenders see you as riskier. That's the cascade effect most people miss. Another layer. Banks may start favoring younger consumers with higher balances or riskier spending habits simply because their math produces more profit. Meanwhile, retirees, the most financially responsible group, could be punished for staying conservative. That's the subtlety no one talks about in the headlines. Even more, some banks may preemptively increase fees or reduce perks before the law passes, just in case the cap takes effect. The ripple effect can hit multiple times. Your limit drops, your rewards shrink, and suddenly that safety net you relied on feels like a paper bridge over a canyon. Knowing these details now, before the policy is finalized, is how you protect yourself. Let's make this tangible. Suppose you have a $6,000 credit card balance at the average APR of 24%. That balance costs roughly $120 per month in interest, or about $1,150 per year, essentially paying for groceries or a small vacation just to maintain your credit. Under a 10% cap, monthly interest drops to about $50, saving roughly $850 annually. For a $10,000 balance, savings jump to nearly $1,400 a year. Multiply this across millions of consumers, and you're looking at tens of billions in potential annual savings. Sounds amazing, right? But here's the catch. Banks don't look at this math from your perspective. They see their profit margins shrink, and when the math doesn't work, they adjust the product. Accounts get closed, limits shrink, approvals tighten. If you carry a balance, the cap is clearly beneficial. But will you still have access to that credit in the first place? That's where it gets tricky. Imagine trying to save $850 a year, only to discover your credit line was cut by 50%. Now you're scrambling to cover monthly expenses. For retirees, it's even trickier. A sudden change in credit availability can affect timing of tax payments, insurance claims, or even planned travel. That's why understanding the policy's nuances is crucial before it even hits. Banks make money on the spread, the difference between what it costs them to borrow and what they charge you. Currently, banks pay roughly 6 to 7% for capital. If they can only charge 10%, that leaves a margin of 3 to 4%, razor thin. This must cover fraud losses, missed payments, staff salaries, technology, marketing, compliance, and profit. Even a small portion of defaults can make the portfolio unprofitable. Their response? Smaller limits, stricter approvals, and sometimes outright account closures. Analogy: imagine running a restaurant charging $15 for a burger. Costs $12. Profit $3. New law says you can only charge $13. Profit drops to $1. Options: raise prices elsewhere, cut portions, or stop serving some customers. Banks face the same math. They'll adapt, but not necessarily in ways that benefit you. And remember, banks are machines for risk management. They don't care about fairness. They care about numbers. That's why even decades of loyalty don't guarantee your line of credit survives a new cap. Analysts warn that under a strict 10% cap, banks could close or drastically reduce a large percentage of accounts, not because customers misbehaved, but because the accounts no longer meet profitability thresholds. Credit scores under 700 suddenly make you a risk, even if you've had decades of on-time payments. For retirees, this isn't a minor inconvenience. A $25,000 credit line could shrink to $5,000, leaving you exposed. Picture this: 58 years old, planning a home renovation. New roof, updated HVAC, bathroom remodel. You've budgeted carefully, planning to use credit temporarily until a home equity line kicks in. Then one day, a letter arrives. We've reviewed your account. Your credit limit is reduced to $7,500. Your project is stalled. You scramble for alternatives, all because a policy change thousands of miles away altered your bank's risk tolerance. Or imagine needing a medical emergency payment. You expected a $20,000 credit line. Now you have $3,000. You must either delay care, liquidate investments at a loss, or ask for family help, all because of policy ripple effects. Retirees also face less obvious consequences: delayed home repairs, postponed dental work, or a small car repair that suddenly forces expensive alternatives. Credit restrictions are not new. In the 1970s, strict usury laws capped interest rates. Result: limited access. Only high-income households with perfect credit got cards. Everyone else was locked out. Short-term needs pushed people to payday lenders at astronomically high rates. Then came the 1978 Supreme Court case, Marquette versus First of Omaha. Banks could charge interest based on their home state, not the customer's state. South Dakota and Delaware became credit hubs. Middle-class and working-class Americans gained access. Banks could price risk individually. Trump's 10% proposal attempts to reverse nearly 50 years of precedent. Banks respond immediately. Math first, politics second. Caps sound protective, but often limit access more than reduce cost. Internationally, countries like Australia and Japan have similar restrictions. Card adoption is lower. Lending is conservative. Alternative lending fills the gap, often at higher effective costs. Caps push credit into less regulated markets, creating unintended consequences. Even more, this move could trigger a shift in global credit strategies as foreign banks reconsider U.S. risk exposure. When interest is capped, Banks often shift revenue to fees. Expect new account maintenance fees, balance management fees, priority service fees, retention fees. All technically not interest, but still real costs. Rewards programs rely heavily on interest income. Cashback, travel points, and promotional perks are funded largely by interest other customers pay. If revenue shrinks, perks shrink, fees increase, and annual charges rise. Example, a premium travel card offers 2 to 3% cash back. Interchange fees, annual fees, and interest charges fund it. If interest revenue falls, the bank compensates. That $95 annual fee might jump to $150. Or 2% cashback drops to 1%. Or worse, the card is discontinued. Responsible users, paying in full, might subsidize the policy meant to help revolvers. The unintended consequences are subtle but real. For retirees, credit isn't about lifestyle. It's a bridge. Timing mismatches between bills, insurance reimbursements, and emergencies are common. Shrinking access increases stakes. Losing a credit line can force asset sales, early IRA withdrawals, triggering taxes, or asking family for help. Example, 67-year-old has a medical emergency. Insurance will reimburse in 60 days, need $8,000 now. Credit line cut to $3,000. Options, withdraw from IRA, sell investments at a loss, ask family, or delay care. Not ideal. Losing financial flexibility affects independence, lifestyle, and health outcomes. Credit is more than a number. It's freedom and peace of mind. Protect existing lines, keep old accounts open, and use occasionally. Maintain low utilization, under 30%, ideally under 10%. Diversify liquidity, cash reserves, 3 to 6 months, money market funds, HELOC, short-term treasuries. Watch final law for exemptions, fees, and definitions. Plan contingencies, map bills versus available credit, alternative funding, emergency contacts. Consider opening new lines before policy hits. Once cap is active, approvals tighten. Talk to your bank. Ask directly about the impact. Knowledge is leverage. Panic is expensive. Every financial policy creates winners and losers. Cheaper borrowing sounds appealing until access disappears. Biggest risks arrive quietly, small shifts that reshape behavior. If you're over 50, focus on control, access, and flexibility. I'm the Asian girl, breaking down how big decisions quietly reshape everyday money. Stay informed, stay ahead, and seriously, drink some water. You've earned it.
Click here to watch another video. YouTube picked it out for you based on what you like watching.